The investment time horizon is one of the key factors to understand before embarking on an investment journey. Let's find out why. Welcome to another episode of Money Matters. When I ask investors what they want to get out of their investment, I'm shocked at just how many times investors simply say they want to achieve some growth, rarely mentioning their investment time horizon. But returns are returns. Why does time matter? Let me explain. Imagine this scenario. An investor wants to make returns on the markets, and his strategy is to buy an IPO he's been hearing about. He expects if he gets an allocation that the price will immediately rise upon its listing, upon which time he expects the initial hype will calm and the price will fall back to a more reasonable level, perhaps even its initial offer price. This strategy is not deemed as investing, it is more speculation. He is guessing the market based on publicly known information with an anticipation of market movements. Nothing wrong with this strategy, but it is extremely high risk relative to investment strategies with a longer investment time horizon. It has no goal in mind other than to make a capital gain. Imagine another scenario. This time an investor is seeking a long-term investment that follows a buy and hold strategy with a globally diversified portfolio across multiple asset classes from bonds to property to equities. This investment is aimed at helping him achieve a passive and sustainable income for his retirement years, and he has calculated with his wealth manager that he needs to achieve 6% net growth per annum with a lump sum up front and monthly regular contributions over the next 15 years. Given that he has a long time horizon and no need to take income immediately, he is able to ride out the market fluctuations over the next 15 years as long as his portfolio averages 6% per annum. Upon retirement, he will enjoy a mix of dividends, rental income and interest payments to fund his desired retirement lifestyle. Even when he reaches retirement, he still has the capacity to accept some market volatility because he's not planning to disinvest the whole amount, but rather remain invested and enjoy the passive income being generated. So in reality, his time extends beyond the 15 years of contributions. One last scenario to help paint a clearer picture. This time an investor has just bought his first property and it's an off-plan property. So he's made his initial deposit and needs to make a final payment in a little over a year. Until that time, he is holding an excessive amount of cash and wants to utilize it to greater effect. However, he will need all of it back in 12 months' time to make his final payment. This means that certain volatile assets, such as stocks, may not be suitable as we cannot be sure that he will get all of it back as markets may crash. Think of the recent pandemic. Bear in mind that he must take back all of his investment in 12 months' time to make his final payment, otherwise he'll lose his home and his initial deposit. So we must choose assets that give him a balance between getting enough returns and enough assurance that he will be able to get back all of his money and make his final payment. For any given level of risk, your time horizon is a crucial factor to help decide which investments should be used in your portfolio. Before setting off on your investment journey, first you must identify your investment destination. Along with a time horizon, this gives you a target and a run rate and helps set the parameters to help track the progress of your investment. Thank you for joining me on this episode. Ask me a question about your portfolio in the comments below. Let me know what other topics you would like to see in future episodes. Smash the like button, subscribe, and I'll see you in the next episode of Money Matters.